Okay. How to avail calculate depreciation, wear and tear in clinic assets. Now, consumables are added in full. Consumable means we had a list of expenses. All the materials, medicines, dental items, whatever, any bills to be paid, electricity, telephone expenses, any chair repair, all those are consumables kind of things. They're added in expenses. But if you buy any equipment, it is not considered as an expense. It is only a portion of that, what we call as the wear and tear value of that is considered as an expense. So each year we deduct a portion of that cost. For example, you bought an RVG for 1 lakh rupees. You bought it in the first half. Now, when we say first half, I mentioned, of course, the cutoff date is there. I'll give you that. But let's presume first half means April to September. You bought it. You get 15% deduction for it, which means you add 15,000 of that in your expenses, not 1 lakh. That 1 lakh goes into your capital account. In your expenses side, only 15,000 means you have actually, you can say, kind of a rent for that or a wear down value for that. You can say wear and tear value for that, whatever you want to. So assets are always capitalized, which means they have a life, 6 to 7 years. And that expense that we charge each year is called as depreciation. Just to simplify, just presume once again, let's presume 1 lakh, let's presume 10% depreciation. Although medical equipment are 15%, just for the ease of simplicity of understanding, presume it at 10%. 1 lakh, 10%, you bought it in the first half, you get a depreciation of 10%. You buy in the second half, you get a depreciation of half for that year. Let's presume you bought it in the first half. You get depreciation of 10%, and which means 1 lakh minus 10,000. Now the equipment is worth 90,000 in your books. 10,000 is added into your expenses. Next year, you again get a depreciation of that on 10% on 90,000, not on 1 lakh. 90,000 minus 10%, another 9,000 you add in next year to that for the RVG. Now your equipment is valid at 90 minus 9, 81,000 rupees. Clear? Next year, you again have a depreciation of 10%. You get a depreciation of 8,100, which now means your equipment is valued at 72,900 rupees, or let's say 73,000 rupees. You add 8,100 in your expenses. This is the way the depreciation goes on decreasing the value of the asset for the next 6 to 7 to 8 years. This is known as depreciation. Now, there are different slabs for it: 5, 10, 15, 40, 60. Again, it is easier to tell it verbally, but difficult to explain it when you have to calculate it. So all dental equipments, medical equipments would have a written down value of approximately 15% unless specified otherwise. All furniture and fixtures and fittings come at 10%. All electrical fixtures come at 15%. Electrical means all your fittings, switches, fans, glow signs, neo sign boards, everything that runs with electricity will have 15%. Your computer and laptop, 40%, your land and building at 5%. This is the view. If you don't find it, just search it on the income tax website, you will find that list. For example, air purifiers, the new things that were introduced in the COVID times. Otherwise also helpful, if not for the COVID. That comes with a depreciation of 15%. No, sorry, 40% only, as per the list, if I remember correctly. So what is the cutoff date? If you buy it before 3rd October, you put full depreciation. If bought after 3rd October, half depreciation. The logic is less than 180 days remaining. September 30th is 182nd day of the year from April. In a leap year, the cutoff, for example, we are currently in the leap year. 2024, February will have 29 days. So this year the cutoff is 4th October. Even if you buy on 31st March, which is the last day of the year, you will get a half depreciation for that year. Clear?